2025, where investing means lighting your money on fire in increasingly creative ways. Whether it's paying $450,000 to be Snoop Dogg's neighbor in the metaverse, paying $7 million for a JPEG, or YOLOing your life savings into Dogecoin just to make and lose $2 million in less than 1 year, the opportunities to lose money are endless. But today, I've got something extra special for you. I've got a trade that's the financial equivalent of texting your ex at 2 a.m. You know it's a bad idea, but somehow everyone's still doing it. And the best part? It's currently unfolding in real time as you watch this video. But instead of just jumping straight in, I've broken this video down into 3 parts. Boardrooms on Wall Street have started to figure out that if you stuff your balance sheet with Bitcoin, the stock market will pay $2 for every $1 worth of cryptocurrency on the books. It's the equivalent of going to a garage sale, seeing a dollar bill on the table, and paying $2 for it. And this all started back in 2020 with MicroStrategy. MicroStrategy was an enterprise software company that was experiencing declining revenues, a low market profile, and was more disappointing than the new age Jurassic Park movies. But then, in August 2020, CEO Michael Saylor announced that MicroStrategy would be transitioning its cash reserves into Bitcoin. This was the most revolutionary thing since garlic bread. Historically, companies have held their cash reserves in highly liquid, low-risk securities such as U.S. Treasuries. This was a way in which companies' cash reserves could earn more interest than a normal bank account and still be risk-free. The idea of a company putting its cash reserves into an asset class whose price can fluctuate 10% overnight was unheard of. And things only get crazier. Towards the end of 2020, Michael Saylor began to ramp things up. MicroStrategy started raising capital by issuing convertible debt, then turning around and using that borrowed cash to buy more Bitcoin. Fast forward to 2025, MicroStrategy is all in on Bitcoin, and they've done the impossible. They've pulled off a bigger transformation than Kim Kardashian. MicroStrategy has transformed itself from a dying software company to becoming a Bitcoin vault with a ticker symbol. MicroStrategy even ditched the micro. And now just goes by the name Strategy to reflect the new direction of the company. Strategy now has a $70 billion stash of Bitcoins and a $138 billion market cap. Since 2020, the stock has gained over 3,441%, which makes it one of the best performing stocks over the last 5 years. And because this strategy, pun intended, has seen massive success, copycats are now flooding the scene. Because it doesn't matter if you were previously a gaming company based out of Hong Kong, a cardiovascular healthcare company, or a budget hotel management company in Japan. The strategy is simple. Announce you are buying Bitcoin, and investors will buy your stock. Logic has officially died in the public markets, and we're all just NPCs living in Michael Saylor's personal simulation. The answer is actually relatively straightforward. Institutional capital, such as pension funds, mutual funds, or any other giant asset manager, want Bitcoin exposure, but their mandates don't allow for it. A fund's mandates are essentially a set of guidelines and say what investments money managers can and can't make. And many funds have mandates that don't allow Bitcoin as a holding. So by these funds purchasing Strategy stock, they're getting indirect exposure to Bitcoin. Strategy is essentially providing money managers with a convenient and easy way to get exposure to Bitcoin as a holding. When you look at Strategy's shareholder list, it all becomes evident. The Vanguard Group, who has made their negative opinions on Bitcoin very well known, is actually the largest shareholder. Which brings us to the point of this video. This is the worst trade in the history of the stock market. Because Strategy provides money managers with a convenient and easy way to get exposure to Bitcoin as a holding, they are paying huge premiums. Strategy, which has essentially turned itself into a $70 billion Bitcoin piggy bank, has Wall Street paying $138 billion for it. These money managers are so desperate for Bitcoin exposure, they're willing to pay a 100% premium just to receive indirect Bitcoin exposure. And here's the hilarious part. This entire circus could be solved with one simple mandate change that allowed Bitcoin in their holdings. No more financial gymnastics, no more 100% convenience fees, and no more having to pretend like they all hate crypto. So, it probably seems like Strategy has it all figured out, right? They have a simple 3-step get rich quick scheme. Step 1, issue convertible debt. Step 2, throw every borrowed dollar into Bitcoin. Step 3, watch the magic happen as they profit from the appreciation in Bitcoin's price and their own stock price. Wrong. Because they are purchasing Bitcoin with the proceeds from convertible debt offerings, the risk isn't with a margin call, but instead the risk lies in the nature of convertible debt. When the debt reaches maturity, Strategy must either repay the principal of the loan in cash or, if the bondholders choose, convert the bonds into shares of Strategy stock. If the bonds are converted into stock, this would lead to heavy dilution, which would drastically impact the stock price. But the primary risk for Strategy isn't the stock price. It's whether they can meet the interest and principal repayments on their debt obligations if Bitcoin's price drops significantly. Strategy currently holds around 600,000 Bitcoins at an average price of $71,000. So here we are. We've got a company that's no longer really a company, just a glorified Bitcoin wallet that's convinced institutional investors to pay double the value of the assets inside the wallet. And to add the cherry on top, the institutional investors who don't trust Bitcoin are trusting a former enterprise software company turned Bitcoin piggy bank to manage billions in convertible debt.